Welcome, dear traders. You are watching a recap of the Asian session. Stock indexes are unable to regain momentum after the downgrade of the US credit rating and a surge in Treasury yields. After a decline on Wall Street yesterday, risk sentiment was low in Asia ahead of the non-farm payrolls report. The volatile week that followed after the rate decisions of the Fed, the Reserve Bank of Australia, the Bank of Japan and England is coming to an end. On a Friday, market sentiment is shaped by news related to the world's first and second largest economies. The United States will unveil the non-farm payrolls report. The July figures may affect the Fed's rate decision. This is why speculators are awaiting this report with bated breath. Despite Fitch's decision, the US dollar tested a 4-week high yesterday. It climbed amid stronger demand for safe haven currencies. Apart from that, its increase was driven by positive macro stats published this week. Fresh reports confirmed that the economy remains resilient. It means that the Fed can stick to aggressive tightening if necessary, and the greenback was trading in the Asian session slightly below a monthly high amid expectations of a further tightening and rising Treasury notes. It jumped to 102.50 versus its main rivals. However, traders are more cautious today. They are unwilling to open long positions before the release of a crucial data. Overall, the US dollar has been rising for the third week in a row. Its intraday range may shift even higher after the release of the non-farm payrolls report. Speculators also followed news from China. If at the start of the week, statements from China's official boosted a rise in assets, at the end of it, speculators did not pay attention to them. The wave of optimism subsided as the promises of the Chinese authorities to support the domestic economy were not backed by any actions. Hopes waned after the press conference held today by China's policymakers. They said again that the central bank would guide banks to effectively adjust interest rates on outstanding mortgages and support banks to reasonably control the cost of liability. Moreover, these statements were shrinkingly different from those made at the end of July. The new ones did not contain any specific details. They were rather obscure, and thus nobody believes the promises of the Chinese authorities, which worsened the overall situation in the Asian region. Japanese government bonds were also in the spotlight. The Bank of Japan allowed the 10-year yield to move above the cap as long as it stays below 1%. So traders are now curious about how far the yield may climb. For example, this week is expected 0.65%, and this forced the Bank of Japan to buy some bonds back. After the intervention of the regulator, the yen advanced against the US dollar. However, today the dollar-yen pair again slid into the green zone. It was moving in the range of 142.30 and 142.90. A fall in the yen was also facilitated by the yield of long-term treasuries, which jumped to 9-month highs. Until there is no change in the yield curve control, the yen is doomed to fall. It could only resume growth amid a rise in demand for safe haven assets. The dollar-yen pair finished the Asian trading in the bullish corridor, consolidating near 142.70. For the Australian dollar, this week was also rather unsuccessful. After the Reserve Bank of Australia unexpectedly left interest rates unchanged on a Tuesday. The Aussie went down. At the same time, the regulator said that inflation is heading in the right direction. Markets perceived it as a signal that the watchdog would soon abandon monetary tightening. In addition, the Aussie dropped due to a stronger dollar and the risk of sentiment in the stock markets. However, in the Asian session, it was able to test a high of 0.6585. However, it failed to settle at this high and declined to 0.6560. This happened amid a jump in the oil prices, even though the AUD-USD pair was trying to move in the upward range of 0.6542 and 0.6588. It had been tumbling since mid-July because of falling commodity prices and weak demand in China. The Kiwi failed to consolidate above 0.6100 after an unsuccessful attempt to climb. It fell to 0.6077, ending the Asian session in the red price corridor of 0.6076 and 0.6104. It was been dipping for the third week in a row. Today is going to be a busy day. Apart from non-farm payrolls, reports from the European Union, the UK and Germany are on tap. And that's all for now. Follow the updates on our channel and see you online soon.